Hello guys, and welcome again to my channel where I translate technical accounting lessons to a storytelling version, sort of. And in this video, we are going to talk about discounting own notes receivable accounting, which is, in simple terms, accounting related to selling your notes receivable before maturity to another party. Okay? Now, let's go directly to an illustrative problem so that you can relate on that. Okay? And assume that you are Papa G and you receive this promissory note from Baby G Corporation. Again, you are Papa G. So, Baby G promised to pay 1 million as follows. So, on 12/31/20X1, 300,000, and on 12/31/20X2, 400,000, and lastly, on 12/31/20X3, 300,000. But then again, there is a clause about interest payments. And because of it, these payments were added by these interest payments. And again, these interests are based on outstanding balances. Like, the outstanding balance in year 1 is 1 million. That is why the interest payment is 1 million times 10% equals 100,000 here. On the second year, the outstanding balance in year 1 is 1 million, but since there is a payment already of 300,000, the outstanding balance is already 700,000, which is why in the second year, we have 700,000 times 10% equals 70,000 here. Okay? And in the last year, the outstanding balance is now 300,000. Because from 1 million, 300,000 was already settled in year 1 and 400,000 was already settled in year 2. So which is why the outstanding balance is now 300,000 and the interest is 300,000 times 10% equals 30,000. Okay? So that's the promissory note by Baby G and its details. Now, continuing the illustration, as if you sold this flying car to Baby G, which is why Baby G executed this promissory note. Now, aside from that, there is actually a cash price for this flying car, which is 983,116. Now, Baby G obviously did not choose to pay or buy this car using cash. That is why there is this promissory note. Okay? Now, Baby G is a good payer and has already paid for 2 years. However, on August 1, 20X3, Papa G needed some money. You needed some money because you are Papa G as if. So, Papa G sold the promissory note of Baby G to a buyer. It can be a bank. It can be a financial intermediary. So, let's go for assuming that it's a bank. You sold the promissory note of Baby G to a bank at a discount rate of 14%. Okay? So, since you are as if Papa G, you need to account for this. And again, you as Papa G sold your notes receivable on August 20X3. So there are effects. So effect number 1, the responsibility and burden to collect this last 330,000 will be transferred already to the buyer. Okay? Now, effect number 2 is related to effect number 1, is that the buyer will want to earn from the transaction. Because again, the burden of collection is already in the hands of the buyer. And, of course, the buyer is a businessman, which is why you as Papa G will be paid. But that payment is already discounted. Okay? That is why there is a discount rate here. So that's the whole illustration. So from year 1 to year 2, there is no problem. You just have to account the notes receivable. But on August 1, 20X3, you need to make entries. You need to debit something and credit something because of the discounting of notes receivable. Now, how do we account for this illustration? Now, before we go to the discounting, we need to start at the very beginning of the year 20X1. So the entry is simply debit notes receivable, and credit flying car, or sales, if the normal course of your business as Papa G is selling this flying car. And that will be 983,116, which is again the cash price. And actually, because this cash price is different from the face amount of 1 million here in the promissory note, the effective rate is not this 10%. So, you need to interpolate and find the rate that if you use it in discounting these payments here, it will equal to 983,116. Like, if this 400,000 times 1 plus I raised to the power of negative 1 plus this 470,000 here times 1 plus I raised to the power of negative 2 plus this 330,000 plus 1 plus I times 1 plus I, times 1 plus I raised to the power of negative 3, it should equal to 983,116. Okay? Now, to continue our learning, let me tell you that even if we did not do any interpolation, because you need interpolation here, the effective rate for this problem is 11%. And you can check it if that's correct after this video. And if you wanted to understand the interpolation process after these videos, you can watch it because I have links on the description below. Okay? But for now, again, it's 11% the effective rate. Okay? Now, continuing the accounting for this illustration, since there are no problems in year 1 and year 2 based in this illustrative problem, based on here, we can continue this timeline already. So, 983,116 times 1.11 or 1 plus the effective rate, and we will have 1,091,259, and then minus the first principal payment of 300,000 and minus the first interest payment of 100,000 equals 691,259. Okay? Now, before we make entries, let's continue to year 2. So, 691,259 times 1.11 equals 767,297. And then, minus 400,000, which is the second principal payment, and 70,000, the second interest payment, equals 297,297. So, that's the timeline up to the end of year 2.